So you're looking to do business in Japan? That's fantastic. But there's a little thing called withholding tax that can be a real headache if you're not prepared. It sounds complicated, I know, but trust me, it doesn't have to be. We're going to break it all down, nice and simple. Here's our game plan. We'll start with the absolute basics, then we'll figure out who this applies to and for what kinds of payments. Then, and this is the important part, we'll talk about how to slash that tax rate. We'll also look at what happens if you get it wrong and wrap it all up with a clear action plan. Ready? Let's go. Okay, let's dive right in. First things first, we've got to answer the big question. What on earth is this thing? The name sounds a little intimidating, but the concept is actually pretty straightforward. It's really all about who pays the tax and, more importantly, when. Here's the easiest way to think about it. The Japanese government doesn't want to chase your company down overseas for taxes. So they just turn your Japanese customer into a temporary tax collector. Your partner in Japan has to calculate the tax, hold it back from your payment, and give it directly to the government. Simple as that. So the whole process is kind of like a three-step dance. Step 1, before they even think about paying you, your Japanese partner figures out the tax. Step 2, they send that tax money straight to the Japanese tax authorities. And finally, step 3, you get whatever is left over. The key thing here is that the tax is paid inside Japan before that money ever heads your way. Okay, so that's how it works. But the next logical question is, who exactly does this apply to? Let's take a look. The system really targets two main groups. You've got non-resident individuals, think people who aren't living in Japan full-time. But for our purposes today, we're focused on the second group, foreign corporations. If your company's headquarters isn't in Japan, then you need to pay close attention. All right, so we know who might get taxed. Now for the really practical part. What kind of business deals actually trigger this tax? Well, under Japan's local laws, the list is pretty long. It covers things you'd expect, like royalties for patents, interest on loans, all the way to fees for professional services. But here's the number you really need to see, 20.42%. That's the default rate. It's a starting point that applies if you don't do anything else. Now, I know what you're thinking. Over 20% is a big chunk of change. But don't worry, there's a really powerful way to lower that number, sometimes all the way to zero. And it's all thanks to something called a tax treaty. And this, my friends, is a total game changer for your bottom line. On one hand, you have that default domestic rate of 20.42%. But on the other hand, if your country has a tax treaty with Japan, and over 80 countries do, that rate can plummet. We're talking 10%, 5%, or yes, even 0%. Big difference. So, how do you unlock this superpower? It's pretty straightforward, but there's one step that is absolutely, positively, 100% critical. You have to fill out and submit an official form, the application form for income tax convention, to your Japanese partner. And here's the catch. You must do it before they pay you. If you're late, you miss your chance. The 20.42% rate sticks. But what happens if you miss that deadline? Or if you just don't know about it? This is where things can get pretty painful, financially speaking, especially for your business partner in Japan. You've probably seen this in contracts before. It's called a gross-up clause. It's where you basically say, look, I need to receive my full fee, so you guys handle any taxes on your end. It sounds great for you, right? You get your money, no problem. But let's see what that actually costs them. Let's play this out. Imagine you've got a deal for a royalty payment of a nice round 100 million yen. Your contract has that gross-up clause, so you're expecting that full amount to hit your bank account. Here comes the shocker. To make sure you get your 100 million, your partner can't just add 20% for the tax. That's not how the math works. The tax is calculated on the total grossed-up payment. So for you to get 100 million, your Japanese partner actually has to pay out a total of 125 million yen. Their cost just jumped by 25%. That is a huge, unexpected expense that could seriously damage a good business relationship. Ouch. Okay, we have covered a ton of ground. So let's bring it all home and boil it down to a simple checklist. Your action plan for getting this right. Here it is, your 4 essential steps. Number 1, identify. Know if your payments are on the taxable list. 2, verify. See if there's a tax treaty that can help you out. 3, and you know this one, file. Get that form submitted on time. And finally, number 4, clarify. Make sure your contracts are crystal clear about who pays the tax so there are no nasty 25% surprises. And that really leaves us with one final question to think about. This whole topic isn't just about ticking a tax box. It's about your core business strategy for Japan. So take a look at your contracts. Are they truly ready for this? Because getting it right can save you and your partners a whole lot of money and keep your business relationships strong for years to come.